Hey guys, Marcus Cron here. Welcome to Wealth Builders Real Estate Investing Podcast. Today I'm joined by Matt Faircloth, who has a very popular book called Raising Private Capital, Building Your Real Estate Empire Using Other People's Money. So I'm really excited to let him share his expertise today. He's got a lot of experience in this space. So Matt, welcome to the show.
Thank you, Marcus. It's an honor to be here.
Yeah, it's a pleasure to have you on the show. Actually, I should note, when I kind of got into this space, being in the multifamily, raising capital, dealing with private investors, your book was actually one of the first ones that I kind of looked to. So it's kind of cool having you on the show here.
Thank you.
So, yeah. So
it's an honor to hear that. Thank you. I'm glad to hear it made I hope it made a difference. I'm glad to hear that.
So I'm going to give you a little intro here before we kick it off. So Matt is the president of the real estate investment firm, the DeRosa Group. Under Matt's leadership, DeRosa has completed over 30 million in real estate transactions involving private capital, including fix and flips, single-family home rentals, mixed-use buildings, apartment buildings, office buildings, and tax lien investments. Matt has an extensive expertise in connecting passive investors to lucrative investment opportunities through syndications, private loans, and joint ventures. And as I already mentioned, he is the author of the very popular book, Raising Private Capital. So Matt, let's jump right into it here. How did you get involved in this space? How did you originally get into real estate investing?
Good question. I met my wife when I was young and single, living in Philadelphia. Became my girlfriend, and she got me to read Rich Dad Poor Dad. And that opened up my eyes to things. I had some success underneath my belt from a career that I was in as a sales rep. And I had a few dollars. And so I used those dollars to buy a single family home that I lived in. And I rented out 2 of the bedrooms to 2 buddies of mine. And that was my first rental property. And that was just after reading Rich Dad Poor Dad and playing a ton of Kiyosaki's cash flow board game. I spent a lot of my time doing that. And that's really what opened up my eyes to the power of real estate investing, to the point my wife and I, let's get married, we decided to get married. And we also then decided, hey, let's live below our means and buy a house that's a little less than we can afford, and we'll live off of her paycheck. That's what we did. And it was a great move for us. And I'm glad we did it.
Yeah. And that's really cool how you jumped into there. Your wife, like you said, girlfriend at the time, introduced you to Rich Dad Poor Dad. And that's really cool, having that support of your significant other along the way. And I think for me, it was actually the opposite way, where obviously I came into the space. I read Rich Dad Poor Dad like a lot of people do, learning about buying assets and avoiding liabilities, and really introduces people to the multifamily real estate and just investing in general. And I remember giving it to my wife. I'm like, hey, you should probably read this book. Just kind of getting exposed to these types of things, especially when you talk about like living below your means and buying things that are actually going to set you up for later in life. So talk about that as well. Like, is your wife still currently working with you in the business? How's that kind of worked?
Kind of.
Okay.
She did. And for a while, but then now we have 2 young kids. She's kind of like my muse, my board member, the person I go to for inspiration and ideas and everything like that. And she is someone that I, just trusted advisor, but she's got her own initiatives going on. She has a successful brand called the Real Estate Invest Her Show. That's a podcast and a movement and a Facebook community. And they're now a publishing company that just published a book and everything like that. So they have their own thing. And so she's got, what's great is my wife and I have spots where we converge and spots where we diverge. And our convergence is around like advice and masterminding and ideas for each other's companies. And our divergence is around like we work together, but not like work on top of each other where like I'm her boss or she's my boss or whatever. We just kind of like collaborate on things or do special projects for each other. But for the most part, we both got our own thing going on, and we both, have 2 young kids that we're both spending time, working with and everything like that too.
Yeah, and it's even though they're not directly related or working together on specific initiatives at all times, it sounds like you've created a lot of great synergies with your wife, and has resulted in, allowed you to, grow and do great things in your business. And that's such a big thing, is having, when you're committing to something like this in multifamily and in investing, like you really have to have a team effort and have your significant other kind of on board with what you're looking to accomplish. Because if you're going out,
I don't get how people don't, man. I've talked to others that are trying to build an investing business with their spouse not engaged and enrolled in the day-to-day of the investing business. And I'm just like, make it to break through the glass ceiling at that level. I see people with a few rentals, but you got to have your spouse 100% bought in if you want to really grow and expand in this business. They don't have to be working alongside you or anything like that, but they got to get it. And they got to be okay that sometimes real estate investing is going to suck time or money out of your personal life. One of those two things, and probably both. And if your spouse is not okay with you being out on it, again, pre-COVID, if your spouse is not okay with you being out on a Tuesday night to go to a networking event, or cutting a check every here and again for startup cost or marketing or to buy a property or whatever, I don't think that you're going to get very far, because they have to be okay with you investing that time and the money to build the business. I've never seen anybody be successful without their spouse buy-in.
Yeah, that's so important. Just even like you said, doesn't have to be active involvement, but having buy-in, right? Like that's kind of the reasoning why I'd introduce my wife to these concepts on building wealth and buying assets, Rich Dad Poor Dad, which is like really an introductory book into this space. And I remember like when, even for me, I was interested in the topic and going to these real estate meetup groups and also like from an educational standpoint, but networking and building great connections. And then it is awkward. Well, especially, back pre-COVID when a lot of them were happening in person, but, trying to go out on a Tuesday evening and go to a meetup group, it becomes challenging when your significant other isn't going to support you and be like, hey, like that's valuable for you to go to. Or I actually remember asking her to come to an event with me, and she's just like, okay, I'll come with you. She kind of felt out of place at first, but it's like, just getting that buy-in and being supportive of each other is super important.
Yeah. And even, what, Marcus, they could be your best cheerleader in the world. And that's all. That's what it is. And I mean, for me, just hearing like, hey, honey, I believe in you. And and I know you got problems in the business, but you'll figure, I believe that you're going to figure it out. Maybe that's all you need, is those words of encouragement, from your spouse. Now, I have more than that because my spouse is somewhat active, or at least is an advisor that's aware more of what we do. And she used to be very active in the business, but Liz used to keep our books and do showings and do all kinds of other stuff. And, and she decided she wanted her own venture. And also, kids will do that. Your spouse doesn't have to be active. They just need to be supportive, and either the best cheerleader you got, or at least accepting to say, okay, dear, do what you got to do, to advance things forward. So, totally. And the way you create that is by painting the picture of the future. Hey, if we start buying these real estate properties, if we start doing some apartment building deals or whatever, to those of your listeners that are out there, like, hey, well, how do I get my spouse to get it? Paint the picture of what life will look like if you hit your real estate goals. It's not about, I want to have 100 units. Well, get it. And I respect that you want to have 100 units. That's awesome. But why don't you tell your spouse what 100 units is going to do for you, and what life you can live with 100 units? What's life going to look like for the kids, and what legacy can you leave, and what charity work can you do, and how many hours is it going to free you up on? They don't care about 100 units. They don't. If they didn't drink the real estate Kool-Aid like you and I did, 100 units means nothing. That just sounds like a bunch of work, is what 100 units sounds like.
Totally. Yeah, I agree with that for sure. And even looking at our next purchase, if we're going to go buy something to kind of be a little bit bigger for our growing family, and looking at stuff that's going to be kind of that, well, you hear it all the time. And I know you're kind of involved with bigger pockets and stuff like that, like the house hacking and trying to find ways to make your primary residence a little bit of an investment property as well, by being either a mortgage helper or actually helping a cash flow. So just as we look for that, introducing those concepts, it's almost a necessity. And I mean, like for the area that I live in, where real estate is super expensive, it almost becomes a necessity to buy into a place with a rental income, because it's so expensive to go and bear this big mortgage on your own. Let's talk about your evolution, how you kind of came. I know you kind of went in the fix and flip space, into single family, you're into multifamily now. Like a lot of people talk about kind of going, especially nowadays, is like, okay, skip that, go right into multifamily, go big or go home. Talk about that middle ground. Talk about how you scaled over time, and how you didn't just bite off this huge chunk that you might not have been able to manage right off the
Mhm.
bat. Talk about scaling up and how you did it.
We did it kind of inch by inch, one foot in front of the other, and it taught us a lot. We learned a lot about smaller property landlording and about, growth and expansion over time and everything like that. We grew slow and steady. Like we bought singles and doubles and then triples and then quadruples and scaled up and scaled up from there. That's one way to do it. And I recommend that way. I think there's two ways you can scale, which is what I did. And I would tell people, if you want to do that, just have maybe a goal of doubling your portfolio every time you do a deal. So you start at 1, then you do 2, then you do 4, then you do 8, then you do 16, then you do 3, so scale up that way. Or you can find a talent that you bring to the table and bring that to someone else's team and join an existing team that has a reasonable amount of units and everything like that. And then you can add value out of the gate, right? Those are the two ways that I know that you can scale. We did it the first way. I know other people that kind of joined teams and then splintered off eventually and everything like that on their own. And there's no right way to do it. It's just, which way speaks to you.
Yeah, and kind of having that long-term mindset of, some people might drink the Kool-Aid and then it's like, okay, I got to go bigger, go home. I got to do it right here, right now. But I mean, real estate really is that long-term investment.
Too many people want to get too big too fast.
If you treat it with that mindset of like, okay, I'm going to be investing for the next years and years and years of my life, you can take off manageable bite-sized chunks and how you kind of grow and start investing. So let's talk about that evolution in terms of when you kind of realized you hit that point, when you started raising private capital, when you started bringing in investors where you couldn't scale fast enough through your own capital, and then you kind of started tapping into your network to either do joint ventures. Can you talk about that evolution?
I wish I could say like, oh, you know what, Marcus, we hit this this point and we're like, okay, this is when we're going to raise money. We're going to raise money in a year, and this is how we're going to do it. We kind of stumbled into raising money, but then when we figured out that it was really a great win-win and enabled us to scale and take down deals that we couldn't do on our own, that's when we were like, okay, we're going to build this out. And now we have a pretty good machine for capital. But my first capital deal was, aside from immediate family, like my parents and my wife's parents, were able to work out a few things. Like they owned their homes free and clear, right? By the way, 1/3 of America owns the home they live in free and clear. Do you know that?
I know that.
So they put a home equity line on their house, and we used some of that money for our first couple of deals when we first got going. A lot of people should consider that. But once that had gone, and once we were already rolling and doing some stuff on our own with our own capital and everything like that, we were moving along. And then Liz was getting reacclimated with one of her friends from grad school. So she was telling this friend from grad school what Liz and I were up to. And this friend from grad school was like, a stockbroker on Wall Street working 80 hours a week. And she was like, yeah, my husband and I are buying real estate, doing some real estate deals. And this guy says the magic words. He says, man, I sure wish I could invest in real estate too, but I just don't have the time. Ha!
Yeah, that's the golden words that you want to hear.
Yeah, man, that's the golden rule. Yeah, but I have time. You don't have time. I have time. Let's talk about that. And so it turned into a beautiful partnership with me and this private. I went up and met him in New York, and we sat down. We had coffee. We talked about deals, talked about real estate. He had some money he was trying to put to work, and so we got together and bought these 2 little single families in Trenton, fixed them up, leased them out, refinanced them, gave him all his money back. And then we took that seed capital and rolled it over and did a bunch of deals with it. And that was just mind blowing. And so he went and got a few of his other friends. They got in with me. And then that's when I was like, this is amazing. And so we were able to build our portfolio pretty quickly by just working out fair equity slices between me and the partners. And me and those equity investors, with the splits that made sense. And then we started researching more complex structures like straight syndications and, SEC filed stuff and everything like that. Because those initial deals, they didn't need to get filed with the SEC because my partners were active. Like they were doing something, which once you don't plan on having your partners do anything at all in the company, if they're 100% passive, it's a true syndication. So that's when we got into that. We learned how to do it, hired the right lawyers and all, and we were off to the races from there. And we scaled small. We syndicated a 10 unit, then we did an 18 unit, then we did a 49 unit, then we did a 198 unit. And that was, off and running from there.
You kind of stumbled into the space of finding somebody that's interested in an opportunity. You provided them a great opportunity. They want to get involved in real estate. You are the solution to what they were looking for, because they don't have the time and they didn't have the expertise, and they get to leverage you as that person. That's kind of their entrance into the ability to invest into real estate. So can you actually talk about that concept in a little bit more detail? Like, some people think this space is in capital raising private capital, that you're just trying to convince somebody to invest in a deal or convince them to cough up this amount of money to come in and join a deal. But it really is the opposite way, where you're actually presenting an opportunity to them.
It's interesting because people are like, well, how do I convince people in my network to give me money? And it's like, you got the whole wrong context right there, buddy. Like that, you stop calling it convincing, because you've got to turn it around and realize that as much as they've got the checkbook, you've got the opportunity. And Raising Private Capital talks about deal providers and cash providers. And a deal provider brings just as much value as the cash provider does. They do, until you realize that you and the investor are equal in what you bring to the deal. It's going to be hard for you to powerfully enroll a lot of investors into your opportunities, because the bottom line is cash providers that want to get into real estate investing, their options are limited. Yes, there's CrowdStreet, and yes, there's this, yes, there's that, but they can't pick up the phone and call the people that are active on their deal. There's a reason why a lot of those portals do okay, but they don't blow out, because people still want to be able to reach out and touch the person that's running the opportunity, or some people do. I think that those folks that are, looking to invest as cash providers, Wall Street's what they got, and a few other alternatives. And so you're offering them an opportunity that has tax benefits, that has many other benefits or whatever, to reach their financial goals that they wouldn't have without you. And so I think you got to approach it with that mentality. They need you to reach their financial goals. They need you to hit their wealth. They need your help to hit their wealth. Without you, they are subject to the roulette wheel of Wall Street.
And how do you go about communicating that in a way? Because I mean, you can explain that and it sounds like, okay, yeah, I've got the opportunity, but how do you go out and actually position it that way, not coming across needy or anything like that? How do you go and position yourself if you're going to be talking with private investors about an opportunity?
Well, I think that it's really about, with a level of excitement, with the level of true authentic, like, hey, listen, you can make you can achieve your wealth goals by working with me. And I can probably show you how what I do as real estate investor will produce better tax benefits and leverage versus what you can get on Wall Street. Wouldn't you love to hear more about that? Wouldn't you love to drive past your investment on your way to work next Monday? These are ways that you can broker those conversations. To not appear needy that's just a level of confidence that you got to have. And honestly, Marcus, that comes after you've done a few deals, because then you realize, hey, this works. These people really do need me. And that was actually pretty easy, getting somebody to write a check. The first equity raise is hard. And then equity raises after that get a lot easier as you grow and scale.
Yeah, perfect. So can you talk about some of the different ways that you can actually structure deals from a passive investor standpoint? I mean, I know you talked about a few different ways that you did early on when you started doing joint ventures. You did active involvement with an investor. You also started going into the syndication route.
We got started doing just small equity deals. We also did some private loans. I recommend people start with private loans, because those are super easy to structure. On small equity deals, we just formed an LLC, and you got to make sure the LLC operating agreement says that you're both active partners, and it says who's going to do what. And it could be like, hey, listen, my stockbroker guy in New York putting in 80 hours a week, he doesn't have time to go and meet contractors at the site or go help collect rent or whatever, but he can keep the books, or he can audit the financials or whatever, or kind of sit over my shoulder on things. I'm fine with him doing that, and he can do that. So the operating agreement just lists those things out. And that's what you would call just an active investment arrangement. On the passive side, it's still an operating agreement. It's still subscription agreements and things like that. You get a little more complicated. You get a document called a private placement memorandum, which is when you're working with non-accredited investors, and the paperwork can become, measured in inches, and that people need to fill out. But it's still not that complex. And you just got to hire a good enough lawyer. Don't, and even on the small stuff, hire a lawyer. Don't be tempted to go online and buy, from, these websites. There's websites out there right now that you can go and buy a PPM for a real estate syndication for a couple $100. It's like, oh my goodness, that is so short-sighted. You can. I don't think you should though.
It's going to cost you more than a couple $100.
Cost you a lot more than a couple hundred to defend yourself. Yeah, man. Yeah. So that's what I recommend people do, is just hire a good lawyer that comes well recommended, that still has affordable rates, that knows what they're doing. And there's a lot of them out there that you could hire. So it's not, but the legal documents themselves are not that different. It just has to do with what they say.
Yeah. And can you talk about some of the different accreditations for different types of investors? I mean, depending on the type of deal you're doing.
It's interesting, Marcus, because it's changing, right? So currently it says an accredited investor has to either earn $200,000 a year if they file by themselves over the last 2 years. And again, the people, you got to Google these things because there's a lot more detail there, but I will paraphrase it for you. You got to earn over $200,000 a year for the last 2 years and reasonably expect to earn that in the next, for the foreseeable future. If you want to qualify by yourself, if you want to qualify with your spouse, it's 300 under the same parameters, right? Because maybe you got two spouses that are both earning 150K a year or something like that, right? So it's 300 if you want to qualify with your spouse, or you got to have a net worth of over $1 million, not including your home, but that does include your retirement accounts, cash, stock, business valuations. You could even throw in, I believe you can throw in whole life insurance in there too. And so just any asset you have, add it all up. That's your net worth, just without your primary residence for one reason or another. That's another way to become accredited. And the SEC is starting to add more accreditation standards in there that you can. And by the way, it's the 200,000 or the 300,000 or the million. It's not this and that and this and that. It's just one or one of those other things, right? And the SEC is also adding that if you have one of the stock brokerage license, like a Series 7 license, and there's some other ones out there too, if you have one of those licenses, then you're automatically accredited. I believe if you're on the C-suite, CEO, CFO of a certain size company, then you're accredited as well. So there's a lot to it. You can look it up online. That being accredited then allows you to invest in certain deals. You can also invest in deals that are set up for non-accredited investors, but the rules change, parameters change. As a syndicator, we can only sell to but so many non-accrediteds, or what are called sophisticated investors. It changes. It also governs what the syndicator, us, are allowed to do to attract investors. So if you are out doing aggressive marketing and what's called soliciting, meaning and you see everybody doing this, they shouldn't be doing it, but they do it, putting on Facebook, hey, I'm buying an apartment building and you can buy apartment buildings too. And isn't that awesome? And all that. That's a solicitation. And you got to be careful with that, because if you're not taking accrediteds only, then you are soliciting, and you should certainly be careful about what you put out there on social media about your credit, about your deal, and what kind of returns you can pay and everything like that. And so folks need to be aware of that. You need to be wary of what you can and can't say. It is something that people get in trouble for. And that you can't promise returns. You're like, I promise I will pay a 15% return on your money. Yeah, you can say what you did in the past. You can say what your projections are. You can put lots of asterisks and exits on there too. But that's why these things matter, because the SEC does regulate this. You can also raise some non-accrediteds, but you can't solicit, and they have to be someone you have a significant pre-existing relationship with. So your Uncle Charlie, your cousins, your neighbors, your Aunt Sally, somebody you went to high school with, all those people all are qualified because you have a pre-existing relationship. What the SEC doesn't say is, I met Marcus at a networking event last week. Marcus and I had one phone call. We talked about how awesome each other was, and we talked about real estate for 5 minutes. Is that a pre-existing relationship? The SEC doesn't define it. There's people that have rules out there that say like, well, I require that we have 3 touches, or I require that you have to have known them for 3.5 years, or I require they had to send me a birthday present last year or something like that, right? Whatever it is, the SEC does not define what a significant pre-existing relationship is. And there's a reason for that. And that's so that they've got that as a means that they can challenge you if they need to. They want to let the courts define what that is, not in, they don't want it to be in the code.
Yeah, and really what they're looking to do with that is just protect the investing public from knowing what they're getting involved with, from the PPM that's out there to kind of inform the investor every single risk that's involved, all the details of the deal itself, and kind of understand fully what they're getting into, but also from the aspect of they consider an accredited investor. Well, that person has built up a substantial amount of income or net worth that they must have some level of sophistication that they're going to understand how to make it investment decisions. They're kind of like, okay, SEC and other securities commissions will basically say, well, they know what they're doing. They're grown adults. They can make decisions on what they're going to invest in, allowing them to have access to a broad range of private placements. And really they're just looking to protect those people. If something does, like these people that you kind of are saying are going out and soliciting for investments, like they might not get caught right off the bat. They might not have an SEC person or looking at what they're posting online, but the biggest thing is down the road when potentially something goes wrong.
Well, and then the SEC comes in and is like, well, how'd you meet him? Like, oh, I met him at a real estate meetup. And then 3 days later, he asked me to invest in a deal and he filed me, and I'm not accredited, which means he had to have a pre-existing substantive relationship. Oh, okay. And you only knew him for 3 days, huh? Okay. If your deal goes south, or if your deal gets squirrely, then an investor tends to turn you into the SEC. Or if they just decide that they're just not happy in general, then it can unwind that way, which is why it's important to have your act together and do things the right way, so that if there is an issue, and I mean, sometimes these things don't go perfect, and it might not be your fault that they called the SEC on you, but if the SEC catches you on a technicality or something that you did wrong in the deal, the repercussions can be very stiff.
Let's talk about on the other side, like what are some of the benefits of passive investing? Like what are some of the problems that we solve offering these types of private investments to people that are going to join as passive investors?
Oh man, it's there are tons. We do C-class value add as a company, meaning like we go and buy C-class asset and we go do big investments in it to make it stable and to make it home and to make it a way better asset than it was before we bought it. So there's the feel good aspect that you're providing solid, secure homes for the larger population of America. But beyond that, there is the returns. They can be lucrative, but they're also secured by real estate, which means that there's something standing behind them. I mean, if you go buy shares in Microsoft and the shares go to zero because the CEO was a bad actor, you can't go take the CEO's house. In real estate equity, the syndicator and the other folks that are in line with them are kind of in bed with you, and they're liable as well. They're obligated. They're probably co-signers on the mortgage. They're a lot more vested than a lot of the Wall Street investments that you can do. That's number two. I don't know how this works out in Canada, but in the US, if you invest in a syndication and it makes like, $5,000 in a year, you will likely not pay tax on it anywhere near $5,000 a year. And if the syndicator does a really good job, you may get a K1, which is a tax item that you send to your CPA for your investment at the end of each year. So your K1 may say that you lost money, even though you made 5,000. If the syndicator does a good job, you get something that shows that in the negative as a profit. It's really cool. Okay, what that means is that that you can earn money, but you can legally show the IRS that you lost money, meaning it's a tax write-off, that you can use it to apply to other gains that you might have on your other passive investments. And if you got nowhere to apply it in year one, it'll carry forward to other years. And then finally, leverage, meaning like what we do, like I said, we'll go in and buy a really sick puppy apartment building, renovate it, turn it around. And then I've added a bunch of value to it so I can refinance it or sell it. And when I refinance it, I can pull out a bunch of money tax-free and give it back to my investors. So for all those reasons, it is a phenomenal investment.
Yeah, there's just so many different aspects to look at. And yeah, and you were referring to the different tax benefits as well. And And much like the States, Canada here has similar types of tax treatment. I'm going to take it into the final 4 questions. What is your favorite real estate or business book?
I probably would still go to the book that changed my life, which was Rich Dad Poor Dad. And you probably get that all the time on your show, but I'd say Rich Dad Poor Dad. And I would even second it with Robert Kiyosaki's second book, which is Cash Flow Quadrant.
Okay. So what is one thing you wish you knew when you got started in real estate investing?
That focus is key. That you can't do, raw land one day or go look at rentals the next day and then go look at flips the day after that and then try and do a wholesale. And then if I had focused on a specific effort of real estate, that would have been a absolute scale to my success much faster. And I am successful and we built it, but only since I've been focusing.
What is a daily habit that helps you be successful in real estate?
This is called my go call do list. And every day I sit down, first thing I do before I start working, I don't just jump in and start doing stuff. My go, like my appointments, my calls, people have to touch base with on projects, and then do, which are proactive items. And I do that every day. And I reference that with my week goals, which were created based on my annual goals.
What do you like to do for fun?
I like to run, if that's fun. I like to I'm taking my son to his scouts meeting. So I like to hang out with my kids. I used to make wine. My wife and I have moved since I used to make my own wine at the house I lived before this one, but and I have not set up a winemaking shop here at my new home, but I'm working on that. So, and my wife and I also, before COVID, we did a lot of traveling. So, and we're working on making that happen again soon.
It was fantastic having you on today, Matt. You added a ton of value. You've got a lot of expertise doing this for years, and I'm thankful that you had the opportunity to come on here and share with my audience. So thanks again.
I'm thankful too. Great interview. Would love to come on again soon. Thanks for having me.
Okay, thanks again. Take care.